I recently had a rare opportunity to sit down with Paul MacDonald, who is the Chief Investment Officer and a Portfolio Manager at Harvest ETFs. If you are a watcher of BNN Bloomberg, you might recognize Paul as a regular contributor on that show. Now, this type of thing doesn't really happen every day. When you think about it, these CIOs, the Chief Investment Officers, they truly are the quarterbacks of an investment team. They're responsible for establishing the overall direction of an investment firm, nailing down the philosophy. They lay out the structure of where these teams are going to work. At the end of the day, I guess you would say these people are accountable to the success or the failure of an investment firm. They are knowledgeable people. When I was working as a portfolio manager, every single time, without exception, when I would come out of a meeting with a chief investment officer, I would come out a better advisor, and I would also come out a better investor. I've chosen to break this interview down into two different segments. We cover off a whole lot of topics, and this isn't sort of surface stuff. This is really a good, solid, deep information, just to make it a little bit more digestible. I assure you that by watching this video, you will gain insight, and you will become a more informed investor by following through, hearing what Paul has to say. So let's start by taking a look at part one of the interview. Thank you to the sponsor for this video, Harvest ETFs. For more information, please check out the link in the description below. Paul, welcome to the channel. It is so nice to have you on board here. And as I said briefly, sort of in my introduction to the session here today, having an actual chief investment officer on to share insights and allow me to pick your brain is so valuable. And when I was a portfolio manager, I always look forward to sessions like this. So I really appreciate you putting the time aside to come and share with us. I want to get right into things here, and I want to start sort of with a general top-down view, sort of a state of the union, if you will. Obviously, 2022 has been challenging out there. A lot of investors, I'm thinking, are worried. When I look at the things I look at as an investor to sort of gauge where we are right now, I don't see any real clear indication. There's a lot of conflicting information out there. I want to sort of just start off with the big issue here so far in 2022, and I'm curious to hear your thoughts on it. I was going to say inflation. So obviously it has been roaring this year, taking us back decades in some cases. The central banks around the world, the US Fed, Bank of Canada here, are doing what they can to try and bring inflation down. So what are your thoughts, Paul, on just, are they doing enough? Are they doing too much, et cetera? I'm really curious to hear what you think along those lines.
Well, thanks, Mark, and again, thank you for having me on the show today. And so, just to take a quick step back, when we think about the markets coming into 2022, we already had inflationary pressures, rearing their heads, and we knew that interest rates were generally going to be tracking higher. And so, there's been some exogenous events, of course, things like the war in Ukraine and supply chain issues that has really exacerbated some of these inflationary pressures. And of course, the key drivers of the market in the current environment is, yes, inflationary pressures, but that's leading into expectations for interest rates to continue to trend higher, which with the goal of taming some of the inflation. And so to your question, when I look and talk to our analysts and talk to our team, I've been asking them very specifically, tell me something good. Find me a market that has capitulated and show me some green shoots. And so the bad news is that there is not a lot of optimism, and there is not a lot of indicators that are suggesting, things have already turned. So the one flip side to that is that we can measure investor sentiment. We can measure other indicators that tend to lead some of these inflationary pressures. And with a degree of certainty, I can say that investor sentiment, both on the individual basis and on the institutional side, is near levels that we haven't seen since the financial crisis, and prior to that, early 1990s. And so when there's an old adage in the market, buy fear and sell greed, certainly a lot of these indicators to us would be indicative that there is a lot of fear continuing out there. Very quickly and specific to your point on inflation, which we hope that the Fed is looking at similar types of indicators. We do have some early green shoots of optimism that those pressures are subsiding, but we do need the data sets to start to actually filter through it, and that to filter through into the real economy.
I'm hearing some optimism, what you're saying there. And I guess the question is, do you feel that they are doing, or they have done what they actually need to do to get inflation under control? I also heard a little bit of, well, we don't know that yet. It's just, obviously we never know, but what are you seeing? What are you hearing out there?
So two things. The first thing is on interest rates. If anybody thinks that the Fed is done raising rates, they're not. We can look at various types of probabilities and likelihoods of interest rate increases between now and, say, February of 2023. And unequivocally, the directionality of those interest rates is higher. The data that we look at tends to be forward leading indicators. So I like to use, one of my favorites is a supply chain congestion index, for example. When I talked about some of those exogenous events causing pressures on inflation, supply chain was absolutely one of those things that really caused additional tightness, if you will, in the inflationary pressures. And so the good news is if you forward that against inflation, that supply chain congestion index, it does tend to be about a 6-month lead time to CPI. That's one of about 4 or 5 different key indicators that we're looking at that, again, tend to lead the actual CPI by about 6 to 9 months. We do see a fairly clear trend that they're rolling over. And so the type of environment we're in, though, is we're in a bit of a purgatorian type of market where we need to sit and wait before we can ascend really to, optimism. We need the data to actually improve. And so these are early signs that, okay, whether it's the Fed itself's policies just starting probably now to filter through into the economic activity, but also the cure for high prices being high prices, that does slow down some of the discretionary spending, et cetera. We're starting to see some of that filter through. We don't see that yet filtering through, though, into Fed policy. And so the timing of exactly when we see these pressures subside and the magnitude are still to be determined. And so as we kind of look out over the next 3, 6, 9 months, these are going to be key areas for the market that we're going to be watching, in particular on the absolute data, but also some of these leading indicators to give us some guidance that, perhaps we're not ascending into the level of growth we had in past cycles, but certainly a stemming of some of the volatility that we've seen in the very short term here.
Very deep in what you just explained there. What it did bring to my mind, a number of months ago, probably earlier in the year, I put a video out on just the topic of stagflation. And this was sort of before we're in the times we're in now, and just the possibility or the probability that we might be moving in that direction. And a lot of our viewers had never even heard of stagflation. And I don't want to, this video is not on stagflation, but just all tied in here. Do you have any thoughts on the likelihood, are we going there? I won't put words in your mouth. I'll just let you sort of answer that, Paul.
I would take a step back just on stagflation, and I'll link it into, stagflation might not, high inflation, slow negative growth for a longer period versus a period that might be more commonly recognized as a recessionary environment, for example. I don't think under those scenarios it necessarily changes the investing playbook, meaning that, we had a debate, I remember, a fairly heated one actually in May. I think it was in May, we had the second quarter of negative GDP growth in the US. And of course, we had the president saying, oh, that's not a recession. And technically, he is correct, although that's what industry and most participants have deemed as a recession in the past. It's technically not a recession. And so I think the playbook from an investment perspective doesn't really change a whole lot, whether you're looking at slowing growth, negative growth, and high and moderating inflation. In either of those cases, I think the looking for areas of the market that have some relative visibility, really being focused in good quality. And of course, I'm talking on the equity side of portfolios, which is where we're focused. And of course, volatility is one area that we think, even though it's in the shorter term, everybody feels the volatility and it has moved higher. That's also a post-pandemic trend that we think is going to be structurally higher going forward, meaning even as we go through the cycle, and it is a cycle of getting inflationary pressures under control, even once we move through that, whether it's 6, 9, 12, 18 months out, that volatility curve, because of the changing geopolitical landscape in the past, call it 2-3 years, we think volatility is going to remain elevated at least for the intermediate term here. And that's both to the upside. Sorry to interrupt. That's both to the upside and downside. Volatility is two ways. So, but people should understand the volatility we expect would remain high going forward.
I always find it interesting that when we hear volatility, we think downside. I mean, people are fearful of volatility, but as we know, as an investor, it can be our friend because it goes both ways. I want to ask you, Paul, about something that's sort of related but a little bit different. But I just want to talk about in 2022 so far, the U.S. dollar, which is sort of tied, obviously, to everything we're talking about here, has risen against, I think, most global currencies. And as a Canadian investor here, obviously, there's an impact if we own U.S. assets. And also your portfolios. I mean, you own these large multinational companies that do business around the world. So maybe if you don't mind just a minute or two, just talking about what we need to be aware of as investors if we're going to be investing outside of our home company, and maybe even specifically to your portfolios that you manage, what impact the strength of the U.S. dollar has had, positive or negative, on that.
Great question. And currencies are a very difficult area of the market to really predict. I guess if I were to take a step back, if we go back a number of months when we had oil prices just ripping, we had commodity prices just ripping, and that was also part of those higher inflationary prints, which we're starting. Of course, people can see it at the pumps, but also in other commodity, we see those prices subsiding. I'm quite surprised that we did not get more lift in the Canadian dollar. And so I haven't really determined exactly why that is the case in a normal, a cyclical environment where commodities are really ripping, that, it didn't flow through more to Canada. On the flip side, absolutely, though, we all have different areas that we like to think we go to when it is going to the fan. And so unequivocally, when we look back, though, the place that investors go to is the U.S. dollar. And so we very much have seen this on a global basis, that the U.S. dollar strength is, it's not necessarily about Canadian dollar weakness any longer, or relatively it didn't perform as much in the higher commodities. This is about U.S. dollar strength. And when the world is unsettled, quite often you see it in gold, but more so you would absolutely see people flocking to the U.S. dollar. So what does that mean from our seat and our portfolios? And so most of our equity income strategies will have different classes. We do leave that for investors depending on what they're looking for. Most of our currency portfolios are currency hedged in the A class. Unhedged, which means you get the movement of the dollar, and we also have U.S. dollar classes for those that are looking to get U.S. dollar exposure. And so I would suggest, though, to your point, when you've had a really good move in the U.S. dollar, it doesn't mean that it doesn't continue to strengthen. And certainly as the Fed continues to raise rates, maybe that is the case. But during those times, ex post, from our perspective, hedged tends to work better if you have a view that the perhaps U.S. dollar is going to at least flatline or come off a little bit relative to other currencies. So.
Awesome. Yeah, I do find in our community that watches our videos, there's this huge interest in hedging currencies, etc., and the effect. In practice, I think very few people actually manage that. And I've always said, if you don't want to go in that route, it's okay. Just go with your A series or your B series and ride it out. And over time, as in being a long term, the decades, it tends to flatten out. But if you are so inclined, I'm like you can take advantage. And just to reiterate, with the funds, I believe all of them, at least the ones I've looked at, you do have an A series, which is hedged and a B series, which is unhedged. Am I correct on that?
That's correct, and quite often have a U.S. dollar for those that
And-
want to have a Canadian domiciled asset.
Yeah.
That is in U.S. dollars. We have that, but you're absolutely right. It's difficult to make the call on currencies, but after big moves in the U.S. dollar, sometimes the hedge does make sense.
I want to shift a little bit out of North America, or just look at a more global scope, and just sort of to sort of set the premise of what I'm talking about here, or what I'm going to talk about. The world, the investment world, has shrunk so much, even in the time I've been an investor, and everything seems to be so closely intertwined now. And of course, we're seeing that. And I'm just going to say, sort of generically, geopolitical events. The big thing going on right now is the conflict over in Ukraine, obviously. Just your quick thoughts, Paul, on the effect that that's having globally on the equity markets, but specifically maybe on some of the funds that you manage. And a question I would have is, when you look at geopolitical events, you have investments all over the world. Do you focus, as you're doing your due diligence and your analytics, I guess you'd say, do you focus specifically on those regions, or do you take a more broad global view when you're laying out your strategies?
So we typically focus into companies that have global operations, but are listed on developed markets, predominantly in North America.
That's part one of this series, and I trust that, as I said at the beginning, you got some very valuable insights out of what Paul had to say. Now, video 2 is going to be out soon, and in that video, we cover off geopolitical events and the role those play in investment, covered calls. We cover the Fed decisions, what they've done, where they might be going in the future. We cover off black swan events, the overall strategies, and we're going to look at some sectors that Paul feels that at this point in the cycle right now are a good place to be invested. So if you're not a subscriber yet, I would encourage you to subscribe and hit the bell for notification, because I'm sure you want to see that next video. I will put a link in the description below for both Harvest ETFs and for our Investing Academy. I thank you for watching this video, and I look forward to seeing you in the next video.